So it's now my great pleasure to turn this over to Terrence Wall, CEO of TWall Enterprises. Terrence, the floor is yours
Well, thank you
and
very
welcome.
much. And I want to just thank Forrest family for setting this up, and thank everyone for joining us today. We're going to be talking about investing in real estate, and specifically in some opportunities that we're able to present. A little background on myself. I came out of the real estate program at the UW-Madison, which is ranked #1 in the country. I have 40 years of experience in real estate and actually developing real estate since I was in college, before I even graduated. And I was the developer of the largest office portfolio, including 5 retail centers, an industrial park, and thousands of apartment units over the last 40 years. Also considered one of the top 5 with our banks in terms of multifamily developers in the state of Wisconsin. So we're going to talk just a bit about, how did I get started, and really what happened was in college, there was a recession. The economy goes through different cycles. There were no jobs available at the time when I was going to be graduating, so I decided I had to wear out some shoe leather. I went and got a broker's license and started representing property owners and selling their properties. Bought a 48-unit apartment project that was really run down and had a lot of problems, 500 police calls in the prior 3 years. And I bought it with a 100% loan. The bank just wanted to foreclose and then turn it over to me as quickly as possible. It was full of criminals, which I didn't know at the time. And my sister was a police officer, so we went down there and found out that a third of the tenants were wanted on outstanding warrants. And this was my start to real estate. So I ended up buying a cell phone at the time, and I was taking calls in class. The professors would stop the lecture so I could take a leasing call, set up an appointment. And they thought that was the funniest thing at the time, when cell phones had just come out. So I got a start getting my hands dirty, fixing up a property, learning the hard way, doing the hard knocks and all of that. And then went on to develop some office and retail, industrial, et cetera. So I come from the school of hard knocks. I'm also a pioneer in green initiatives, the only developer to be recognized by the governor for green and sustainable efforts, also by the mayor of the city of Madison. We have done some pioneering efforts. We had the largest solar array on an apartment building east of the Mississippi River in the United States. We are the first to beta test electric charging stations for electric vehicles in our properties, and just a whole series of other things. We actually taught a company called Focus on Energy, which is the nonprofit here in the state that teaches others how to do green and sustainable initiatives. We taught Focus on Energy how to do all of that. And that went on for about a 5-year period, actually. So we're very, very good at the green and sustainable initiatives. We also did one of the first conversions of wetlands, which is held up as a, really a case study by the Army Corps of Engineers. They told me that they use it as an example of the right thing to do and how to do it when converting wetlands and making new wetlands. And that's right out of the mouths of the people at the Army Corps of Engineers. So I pride myself on the green and sustainable initiatives. In terms of our company, we've had some good success on returns. These are properties that we have sold or provided exits to investors. And these returns run from 8 to 36%. The bulk of them are in the 15 to 30% range. Most of them are in the 18 to 25% range. That's cash on cash per year over the life of the investment, and it's not an IRR because this is an actual real figure. It can't be manipulated. Excuse me. And we want to continue to provide these high returns to our investors on our new properties as well. So we pride ourselves on providing really good service to our customers, high returns to our investors, and having really good, high quality properties. that reduce occupancy costs, operational costs, resulting in longer term occupancy by our customers, which then results in higher NOI. We have a great team of people. This is only a few of them. We have a total of 50 team members on our staff. And there are many people who have been here long term. We had 2 recent retirees who had been with me for 30 years and have retired now. So this is we have just a really dedicated team of people. Our strategy is to develop in high growth markets. We usually get some free land or low cost land. We get TIF, which for people who don't know what TIF is, it's a cash grant from the cities. It's basically a rebate of your property taxes. If they want us to come there and help revitalize their city, they'll provide us with TIF. Our specialty, though, is really what I really love doing is creating new communities. It's not just one building, it's an actual whole community. And it's usually revitalizing a downtown or a city center or a neighborhood that's needs help. We get a lot of calls from different communities around the state who lack housing. They have a shortage of housing. They want to help revitalize their downtown. We love to put these properties on the river or lake or on the fronting on a park. And this really helps turn around the whole community. It's an incredible transformation of these local towns and villages and cities. So that's something we're really good at and are well known for in this state. As I said, I've got 40 years experience in the development business. Our properties are literally the best of class. We have wider hallways. We have 1 foot taller ceilings in all of our buildings. We have high-end finishes. We have clubhouses, pools, community rooms. We're putting in golf simulators now, and also we're adding community office space, so I'll call it shared or co-working spaces with Zoom rooms. So that's a half a table up against the wall with a TV, because many of our residents are starting to work from home and they want to have a professional environment, room that they can go to outside of their own apartment and be able to do a Zoom call with a client. So we continue to add pioneering amenities to our properties that other developers don't have. These are just a few of our properties. This is Veritas Village, downtown Madison, just a lounging pool in this property. This is the highest rooftop deck in the county on a property overlooking the state capitol, downtown Madison, and the lakes. Our units have more features than some of the other developers. Little things like ice makers, garbage disposals, pull-out faucets on the sink, glass stovetops. This all is normal in a house, but in an apartment, you won't find these typically in apartment properties, even new ones. And we're the only ones doing these additional features. So the result is that when somebody, if they have to leave our property, they're going to have to go downstream. They're going to go to a lesser quality property. That results in higher occupancy, less turnover. It means less vacancy for us, lower costs, more NOI. So it's just a win-win all around. One thing in particular is we spend a little extra money on the cabinets, higher quality solid wood with higher quality hardware. We have in-unit laundry. A lot of our units have mud rooms, which is unheard of. Just again, trying to do those little extras that will result in retaining the customer long-term. This is also some of our grilling stations and fire pits in downtown Madison. This is Peloton, one of our premier properties in the downtown Madison area, right near 2 hospitals. The top floor there is a clubhouse for all the residents to use. It's stunning views of the lake and the Capitol. So why Wisconsin? We are primarily developing in Wisconsin, although we have started a new project in Florida as well. Many markets here in Wisconsin have a significant housing shortage. They need revitalization of their downtowns, and they just need help. And this is an opportunity for us to do good for Wisconsin and these communities, but also develop in housing markets that lack housing. And so the rents stay up, the occupancy stay up. It's just a great opportunity to invest in these communities. Prime example you'll use here is Dane County, Wisconsin, which is the capital of Wisconsin. Rents increased 28% from 2010 to 2022. Average rental vacancy remains very low. The city is estimating by 2040, we need 139,000 new units. By 2050, they're estimating 200,000 new units will be needed in this market. We can't possibly keep up with the development here. The entitlement process takes too long. There's too many regulations in the way. That results in less new development, which results in sustainable higher rents and high occupancies. So it's kind of a good thing from the perspective of the housing provider to have these factors in place, even though it makes development a little more difficult. Some of the great investment opportunities we're looking at right now that we have on our plate is the Moment building, which you just saw a photo of. And I'm going to talk about those in a second. Basically, I just want to outline the capital structure here. We'll secure a bank loan, typically 75% of the capital stack. And the land value will either be free or a lower cost land in the marketplace. Then we'll sometimes get TIF. A lot of markets will give us TIF. And then we'll have a developer contribution. That is very unique. I just want to point that out. We don't take any cash out in an upfront development fee. We're in there with you, rowing in the same direction. We have the same goals. If you're getting a distribution, we're getting a distribution. If you're not getting one, we're not getting one. We're not taking any money out front. We're contributing 3 to 5 years worth of work and effort, millions of dollars of staffing, et cetera, to get those properties entitled. We're contributing that up front. We're not getting reimbursed for that. And then, of course, the cash component. So that's our capital stack. The investors will receive distributions on an annual basis based on cash flow. You'll receive a larger distribution, and the bulk of the return will come upon exit when we sell. And of course, you get tax benefits from depreciation, and you can use those benefits to either reduce other taxable passive income, or you can put those in a bucket, store them, and wait till the exit of this property that you've invested in, and dump that depreciation out and reduce your taxable, your tax due on the sale. So it's an effective strategy to reduce your overall tax situation, or to reduce the taxes on this investment. That's something you don't get with other investments. This is really exciting. The Moment building. Our slogan is "Live in the Moment," and it's going to be a 15-story building. We tore down a 12-story office building that was at risk of collapsing, just like the condo tower in Florida. We purchased it at a very attractive price. We raised it, and now the site is scraped clean, and we are ready to start building this 15-story building. This is an institutional grade property, which means, downtown, over 250 units, really great amenity package, and a steel and concrete construction. So that means that someday an institution will be interested in buying this property, probably a nonprofit or a tax exempt pension fund. They'll pay a higher price because they are tax exempt for a property like this, because it's just a premier property they'll want to hold on to. This property even has a swimming pool, and in downtown, that's extremely rare. Very little in terms of commercial space. It's all luxury apartments, golf simulator, a real Swedish spa, and it's super nice. The expected return is about 25% per year on average after exit. You can expect to be in this for about 5 to 10 years. And our total equity raise is about $33 million. We've already raised $16 million of that, so we're looking to raise the remainder of that and then break ground this coming winter. This is the location, whited out here on the dot on the screen. It looks over Lake Monona. On the front side, on the back side, it has views of the state capitol building. So it's an incredible location. And I want to highlight something about this downtown market. It's very unique in the United States. There's only one like this. And that basically is because there's a statute that says you cannot build over the base of the columns of the Capitol. So the maximum I can go is 15 stories. What that means is you've got a market where the county purchased up a lot of green space, slopes around the perimeter of the city. They have tightened that belt, and the result normally is then buildings go vertical, but you can't go vertical in this market in downtown or on the east side because of the height limitations of the airport. And that means the only thing that can go vertical is rents. So you just can't build enough here, given the growth, to accommodate the demand because of the limitations, both vertically, but also horizontally. If you look, there's no north or south market here. We only have an east and west and downtown submarkets. Most markets would have a north and a south submarket as well. We don't have that here because of the watershed, the lakes. It's impossible to develop in the watersheds north of here or south of here. So again, limited supply of land. That makes it highly valuable. Great location for steady returns over time. You don't have the ups and downs that you'll have in some of these other markets around the country. And we grow faster than most Sunbelt cities. This is a few photos of renderings of the intended amenities and design of the apartments. Again, we're going to have a swimming pool, which is highly unusual. We'll have an executive garage, which you'll pay extra for if you want to be in that. So just phenomenal amenity package. The investment, we can take common shares at a lower amount, no cap on the returns. You have total upside on the return. If you want to put in $250,000 or more, we'll provide you with a 12% fixed return. If you put in $1 million or more, we'll provide you with a 15% fixed return plus another 3% bonus upon exit, depending on how the price of the property is sold at. So this gives you some very high guaranteed returns if you want to get that, or just go ahead and take common shares and have unlimited upside. Our shares are common shares as far as the developer is concerned in terms of our investment. So we're sitting behind the preferred and the premium preferred. This is a unusual way of doing things, but also I like to have everybody rowing in the same direction. As I said, I like to have us, be on the same page. If you're getting something, then I'm getting it too. And if you're not, then I'm not. And it's really that simple. We don't do complicated waterfalls, etc. The Bozeman is right on the interstate system on the east side. Our expected return is over 32%, 5-year to 10-year hold. The equity we're looking for on that one is $7 million. This would be the first phase of 6 buildings directly across the highway from basically 3 new hospitals and a big office park that continues to grow with different companies coming in. So this is a great location. It's a few minutes from the airport, which is key for the Epic employees. Epic systems where your doctor's entering the data when you're at the doctor's appointment. That's the Epic systems software. They're headquartered here in Greater Madison. And a lot of their employees like to live near the airport because they fly out on Friday and they fly back on, they fly out on Monday and they fly back on Friday evening. So they don't want to have to drive across town. They want to live within a few minutes of the airport. Again, 108 units. It's really the 4th phase because we have 3 other buildings across the street that we've already developed and filled up. This will be marketed under a different name. The first of 6 buildings, as I mentioned, and an incredible site and location. Conservancy Bend phase 2 is already full in terms of its investment. We just finished that out, and we'll be going ahead with the construction of that phase 2 this summer. Covered Bridge, again, the 2nd phase. So this site has already been proven out. First phase is leased up. We've got 4 buildings plus a small commercial building. Really nice clubhouse. This is the first gated, secured community in our county. That may be unusual compared to other cities like Denver, et cetera, but having a secured gated entry is just unheard of here. And we are the first to do that in multifamily. Expected returns over 17%, 5 to 10-year hold. We're looking to raise $8 million to start the 2nd phase. Here's a site plan of the 4 buildings. Our Madison market, I just want to talk about that for a moment. Very unique. The capital is linked via State Street to the university, 6 blocks long. So you have the anchor of the Capitol, the anchor of the university, with 50,000 students, and then a limited market area because of the isthmus and the lakes. We have extremely strong demand here for housing, constant shortage. I have never in all my life ever seen a recession in this market. Even during the worst time of 2008 to 2012, when Phoenix saw 55% reduction in their property values in housing, Madison housing only went down 3%. Our typical time on market for housing right now is 0 to 2 months. And that shortage of single family housing means that people just have to stay in multifamily units because they can't get a house. They get outbid. Some houses will have 5, 6, 10, or 12 offers on them. We have an extreme shortage both in the multifamily and the single family, but yet continued growth. So we have tremendous growth. We're ranked number 4 here in the country in terms of best housing market in terms of multifamily. Our foundation is government, solid, about 20% of the employment, with good paying jobs. Doesn't grow a lot, but it's the foundation. The insurance industry is also another solid foundation. Again, good paying jobs. It's a big industry here in Madison area. Healthcare with 3 hospitals, again, good paying jobs and solid, modest growth. But really the growth comes from the tech side. So we are the technology hub of the Midwest. All the companies are here, you know, Google, Microsoft, Dell, Sony, Amazon, you name it. They're all here with offices and growing. Epic Systems, which is the medical software provider, has 10,000 employees here. And then the construction industry is also very strong. So these are all great paying jobs. It's a white collar industry. We don't have a lot of blue collar here. If we do, it's in the suburbs. It's just a really strong growth market with really high paying jobs. So these are some of the companies. You know, Exact Science is Cologuard, so you may not recognize the name Exact Science. All those boxes are returned here to Madison, where ProMega analyzes them. The hospitals, insurance, the credit union co-op is the headquarters for credit unions all over the country. It's right here. You know, Google, as I mentioned, Amazon, ETC is big here, Covance, you name it. Sub-Zero, you probably recognize that name, Rayovac with the batteries. Fiskars, Eat Street, you probably heard of those. These are all great companies that grow here. Our investors get a portal and access to a portal that provides and tracks all of your investments. It'll track your distributions, your tax returns, your K-1s, et cetera. It contains financial information, including the state financial statements that we deliver. All of that's tracked for you. You have access to it 24/7. So if you ever want to look up the financial statements, you know, everything's open book with us. So you're entitled to review all the financial statements, including the general ledger if you want to. So it's an incredibly transparent portal for your investment. There's 3 easy ways to invest. We provide you with the offering documents. You sign the subscription form. There's 3 places to sign on that. You activate your portal online. And Helen, our investor relations director, can help you with all of that. There's her email and phone number. There's a QR code as well. She'll walk you through all of this and help you get signed up for whatever investment is best for you. She'll give you some advice on based on what your needs are as to what she thinks is the right route to go. So with that, since I want to be respectful of everyone's time, I'll open it up for questions, and thank you very much, Kelly.
Okay, great. A lot of questions have come in. What is the typical time period for the investments and any exits?
Yes, a typical time period is 5 to 10 years. What happens is we'll take about a year, or with the 15-story building, we have 2 years of construction, then 1 year of lease up. The 3rd year, we start to get cash flow, start to issue some distributions based on cash flow. And then within 5 to 10 years, based on the market timing, you know, how the property's matured, then we'll look at, exits on a property by property basis.
Are any of these in opportunity zones? And if so, can you benefit from that?
They are not. We don't do the opportunity zones because honestly, in 2026, the investors have to pay their taxes anyways. So that the clock is kind of run down on those, if you aren't in one already.
And are all of your projects rentals, or do you do condos as well?
We only do rentals. The reason why we don't engage and I won't do develop condominiums is because of 3 reasons. One is you have to pay your dealer status. You have to pay regular income taxes. So you're paying double the tax rate compared to capital gains. 2 is you have to pay the IRS and the bank on a current basis. So every sale you have to pay the IRS a prorated estimate of the gain. And if you misestimate that, tough luck later. You paid those taxes already. That's another, and then third, by the time you pay the IRS and the bank back, and they want to be paid, and the bank wants to pay in a shorter time basis. They don't want to wait for 100% of the units sold. They want to get paid out at 65 or 70% of the units sold. And so you're break even at best. Sometimes you're underwater writing a check for every sale, with your profit tied up in those last 15 or 20% of the units. So I don't like to engage in condominiums because also it takes us, 3 to 5 years before the investor gets involved to develop, get all the entitlements, and get everything ready. And when you put that much effort into it, you want to be able to hold on to it, and sell it for a bigger gain down the road, and take advantage of the depreciation in the meantime. So multifamily, the highest end of the market, that's our niche, and that's what we're good at. I don't like to engage in things that we're not good at. We don't do student housing. We don't do condominiums. We don't do Section 42 tax credit low income housing.
And how do you market these for your properties for exits?
Sure. We have, we'll engage, if it's a single property, we might try to sell that ourselves. Sometimes your highest buyer might be a 1031 exchange, somebody who has sold another property, maybe a developer or just an investor, and they want to do a 1031 exchange. They'll pay you a higher price. If we can package up 2 or 3 properties, we'll market that nationally through a JLL or a Berkadia or Northmark, get a national broker. When we have marketed properties, we have received between 2 and 3 dozen letters of intent. We'll get half a dozen to a dozen offers. We'll be able to pick and choose, obviously, price is one factor, but we'll have lots of buyers, for these properties, and we've proven that. On occasion, I have sold a couple of properties on my own, and I've received the highest price, highest cap rate, I should say lowest cap rate, because that equals highest price. Record lowest cap rates in the state of Wisconsin on the properties that I have sold personally, on behalf of the investors, maximizing their return. So we'll look at that. We'll look at what can we get, what do we think it's worth, but we don't put a price on it when we go to market. We let people bid against each other to get the price driven up and find out who's got cash, who's interested in the market and the property, et cetera. It's about finding the right buyer. You know what I mean?
Do you have fixed price contracts with your general contractors and subcontractors?
That's a great question. Yes, we have a GMP contract for architectural services and also for the contractor. We use a contractor and major subcontractors that we are familiar with and that we've been using for many, many years. They are highly motivated if they want to get the next job, to come in on budget and on schedule, no excuses. And don't call me if you have a problem. You're the contractor, you take care of it. I don't want you to put that problem on me and expect me to write a check. So we have really great contractors. To give you an example, during COVID, when the plumbing team of 4 plumbers got COVID, they had to pull them off the job. And the subcontractor called me up and said, "Hey, don't you worry. I'm pulling another team off some other guy's job and bringing him over here," because he knows where his bread is buttered. He knows I'm his lifetime customer. I'll be around for another 20, 25 years. And he is counting on that business. Whereas the other customer of his was a one-time deal, right? A one-off. So these contractors are very interested in honoring their warranties. They're very interested in making sure we don't have problems after the building is open. And that's hard to do unless you have repeat business. And at one point in time, I was the largest employer of union construction labor in the state when we were doing office buildings, because those are quite more complicated, et cetera. But we're also one of the largest employers of just overall construction labor in the state with the amount of product that we're building.
And what is your typical development timeline from groundbreaking to stabilized occupancy for your projects?
Sure. Typically, for most of the properties, it's 1 year. I call it 1 year for construction, and then 1 year for lease up, and then the third year you're full, and you're starting to set aside some cash from just from operations to prepare for distributions on a quarterly basis. The Moment building is different. That's a 2-year construction, and we're estimating a year and a half of lease up on that property.
And what about? Oh, sorry. Go ahead.
Yeah, I was just thinking these are great questions, right on point.
What is your typical construction budget per unit or per square foot for these projects? And how does that vary based on location or amenities?
Sure, that's another great question. The cost of construction has actually gone up, right? And on the periphery, we're looking at about 210,000, could be more than that, 220,000 per unit. In downtown, we're approaching 275,000 per unit. Some developers in downtown are spending 350 to 400,000 per unit. It's incredible how expensive things are these days, but fortunately the rents here have kept up. We've been able to continuously increase rents. And the beauty of the current situation that we're in right now is that we've been patient. We were patient when interest rates are going up, costs were skyrocketing. We didn't develop, we held off. And now I watch every single week, I watch lumber, steel, oil, everything, all the commodities, and lumber and steel, oil, all those commodities have stabilized. They've come down. The 10-year treasury is down a little bit. I think it'll continue to come down this year. And this is now a really good time to start construction this fall, because when you talk to the contractors, they're like, we don't know what our pipeline is in the fall. They were all busy for the last 2 years doing a lot of government work, school construction. And then you're having a bid against, the government buying services in the construction industry. And, they moved their pricing up because of that. Now that's come down and they're a little worried. So they're being more competitive. So now we're ready. We're ready to launch because the commodities of lumber and such are down, but also the contractors are bidding more competitively and keeping their pricing down this year.
And do you anticipate tariffs to affect any costs?
So not for us. We are green and sustainable. So we like to purchase the vast majority of our materials, et cetera, within 500 miles of the property. That's the criteria to be green. I deliberately do not buy drywall or countertops, et cetera, from China. Some developers did. The drywall came with bugs in it. They had to rip the entire drywall out of the entire buildings, that was installed. Even the countertops, the shipping containers will come with bugs in them. They have to be fumigated. So I refuse to buy product from overseas. It's just unreliable. I think it's better to spend an extra 1 or 2% on construction and get it more locally, better quality cabinets, better hardware, because then your operating costs come down. So my philosophy is different. I'm going to hold on to this property 5 or 10 years. A lot of developers are just selling immediately upon stabilization. As soon as they get that build leased up, they're selling it. So they don't care about the operational costs. And so they go cheap. They try to reduce the costs as much as possible because the impact on operational costs will be on somebody else. It won't be on them. They're trying to make this bigger gain, right? I'm taking the philosophy of better quality, lower operational costs, improved occupancy, more NOI, more cash flow, and a better property to sell long term. That's our reputation in the marketplace. So I stick with that. I'm very adamant about getting good quality materials and products.
And back to being green, can you quantify the environmental benefits, carbon reduction, energy savings of your geothermal and or solar systems?
Yeah, I can't reliably. We looked at doing that once, and I cannot reliably come up with something. I don't want to misrepresent something to somebody. I can just tell you that we were the first to do. We were the beta test for the local utility company for the EV charging stations. We put in the first geothermal in a private building. We're the first to put in solar in apartment buildings. We have the largest solar. We have all high efficiency water flow faucets and fixtures. We have high efficiency electric appliances, et cetera. So everything we do, we have more insulation. So we insulate the walls in the bedroom. We put a sound insulation mat on the floor, but also that provides better insulation against the floor. So everything we're doing is very green and sustainable. There's a lot of people talk about it, but I actually have a track record that I can show what we've done. You can look on Google Earth and see our solar panels on the roof of our buildings. So yeah, I don't know how I can honestly put a number on that. You know what I mean? But we have won awards that kind of demonstrate and back up our activities. And as I said, I taught Focus on Energy how to do these things, like a heat recapture system in one of our prior office buildings. They didn't know how to do that. We taught them how, and then they go and teach other developers. And that went on for 5 years. They funded half of our engineer. They funded half the salary of our engineer because he was spending so much time teaching them this stuff, and I was volunteering my time. But I think that's a pretty good track record to go on.
Definitely. How do you manage interest rate risk given the current lending environment for real estate?
Yes, I watch interest rates every week. For example, when interest rates started going up, before they started going up, when the Fed announced they would start raising rates, I rushed out. We spent the whole year. We refinanced hundreds of millions of dollars of our properties, locked in the interest rates as long as we could to get those low rates locked in. And then I try not to, I won't take a floating rate when rates are going up, right? You want to lock in, get a fixed rate, even if it costs you a little bit more to manage that risk. We're not in the business of gambling on interest rates. We're in the business of developing apartments and leasing them up. And so we don't want to take the interest rate risk, right? I do sit on the Wisconsin Economic Council for the Federal Reserve Bank of Chicago. I'm the only person allowed on that council to recruit members for the council. And so I'm very, very, very keenly tuned into interest rates. It's important to know where they're going. Right now, I think they are going down slightly. I might be willing to take a floating interest rate, that would have a ceiling and a floor on it. So you're basically hedged on each side. But yeah, we don't like to take interest rate risk. We wanna focus on the business, not the interest rate.
And what percentage of tenants are repeat or long-term residents, and how does that compare to the market average?
Yeah, that's a super great question. We find that we're at 70 to 80% of our customers will renew their leases. Far higher nationally. I think last time I looked, it was like below 50% on a year-to-year basis. So we do get a much higher percent of our customers staying and renewing because we provide, it's a lifestyle, right? We're providing them with a lifestyle, not just an apartment. We even hold programming. So we do events, pizza night, movie night. And the reason why we do those things is because it creates opportunities for the customers to interact with each other. And if they are making friends in the building, if they've got a coffee shop that they like to go to locally, some of our buildings have coffee shops in them, then they're more likely to renew and stay because they develop those friendships. They don't want to move out someplace else. So it's about their whole lifestyle package that we're delivering to them. We do definitely have a much higher retention of customers. Yes.
Right. Are there opportunities for family offices to co-develop or secure priority allocations?
We could do definitely do priority allocations for sure. Um, I don't really care for the co-development. I'm kind of a control freak. I know what I'm doing. Don't ask me to go into a hospital and do surgery. I wouldn't have a clue. I stay in my lane, but also I want people to respect my lane. I'm good at what I'm doing. I have a good track record. I don't really want somebody from the outside second guessing the market. I'm very quick to also pivot. For example, I did a flex space building, which is office in front, industrial in the back. Back in 2007, the market, of course, then crashed. Leasing dried up. And instead of just sitting there and doing nothing, I got the team together. What can we do to turn this around and turn this, from a problem into a diamond, And as we brainstormed, one of the things we came up with was, what about a church? And people absolutely thought I was nuts. Like, yeah, why not? Why not a church? And within 6 months, I had a church sign a lease on that industrial building. Who would have thought, right? And within a year, they made an offer to buy it. And our investors made out like bandits. We sold it for a nice profit during a time that was incredibly challenging. So if we do run into a problem, I want the flexibility to move and act quickly, make a change without having to go get some approval from somebody else, co-developer, whatever. It's important to be able to pivot, to adjust to the market. Look at all the stuff that's happened in the world, COVID, interest rates up and down, tariffs, we got to be able to move quickly. And that's one thing I'm good at. I have an economics undergraduate degree. I've always monitored and watched the economy and anticipated what might happen in the economy and how will that affect us in business. The nice thing is, because we don't receive development fees and cash up front, I'm not under any pressure to develop a building. If things change, we can just sit tight and wait until the economy gets in the right position. Unlike others, I love to start a building in the middle of a recession because I get the absolute best construction pricing. And then by that time that building opens up, we're out of the recession, leasing is going strong, rents are going up, and it's a win-win because we got in a lower cost, right? Most developers, they'll continue to plow ahead going into the recession, and then you get in the depths of the recession, then they've sort of hit the wall and they don't want to develop, they're afraid, and they shouldn't have done that. They should have stopped early on and then started at the bottom of the recession. And you have to have sort of discipline to do that, and flexibility. And I don't want to have to have my hands tied. I need to be able to move quickly. When COVID hit, stores had to close down. I went to our retailers on the first floor of this building and I said, what do you need? What help do you need? Do you need some free rent? I will give you 6 months of free rent. We'll extend your lease. We'll build that in on the back side. What can I do to help you survive this? And we were able to get, 80-90% of our customers through that challenge. Yes, a couple did have to close, but we got the rest through. And so you don't want to have your hands tied. You want to be able to move quickly to solve problems and anticipate problems, to take action where necessary, to maximize returns, to decide, you don't want to be forced into selling at the wrong time in the market. For example, we want to wait for interest rates to come down a little bit more and our values of our properties will increase again. And we will probably be offering, a couple properties for sale in the next 2 years. Once the 10-year treasury comes down a little bit more. So again, it's all about, moving quickly, if you see what I'm saying.
Right. Are you raising funds for single assets or multiple assets for institutional and accredited investors only?
Yes, so it's single assets. So you get to pick and choose which property you want to invest in. If you'd like to invest in 2 or 3 at a time, you can do that. We have over 800 existing accredited investors in our portfolio. They pick and choose. And then when we sell a property, almost all of them will recycle their capital into a new investment. So yeah, we don't offer a package. just because I think it's, if you want to create that package, you could do that by choosing multiple properties to invest in, but then it's your choice.
How have you structured past LPGP relationships with family offices or institutional investors?
So it's an LLC, where the manager of the LLC will take a 30% interest in the contribution of the millions of dollars I personally put in for the 3 to 5 years to get the project to ground zero where we can break ground. You put in cash. The beauty of this is I'm not taking anything out up front. And if we get TIF, the investors benefit from that. I'm not taking that extra ownership for myself. That's basically goes to the benefit of all the investors. If we get free land from a city or low cost land, again, we're not marking that up. That's going to the benefit of all the investors. So we share all of that with our investors. We're all pro rata in the investment. Whatever dollars you're putting in, we'll calculate what your percent ownership is, and we're all going forward together. It's just a winning strategy. Our investors love that. It's not me taking money first and then you get some up to this amount, and then it's back to here. Very confusing for people. Everybody's treated equally the same, and it's all pro rata.
Well, I think you just at least touched the surface of this last question on, can you provide more details on how you pay dividends to investors?
Sure. Yes. So first we have to wait, in terms of we got to get it built. Then we have to get it leased up. We want to be up there 95% or more on lease up. So then we'll start generating net cash flow. And then we'll start reserving some cash from the cash flow so we can pay that first quarterly distribution. Again, it's a distribution, so it's not taxable. Your tax return is based upon the tax laws. You'll get a negative tax return, depreciation. So you get to use that to offset other taxable income that's passive. So you get a distribution that's not taxable. And we'll do that quarterly based upon the cash flow. And then we'll start off at a safe number. And then every year we'll look at the budget. We'll hopefully increase, 1 or 2% as the cash flow goes up based on rents increasing.
One last question. If you refinance a property, do you liquidate LP positions or distribute it pro rata as a return of capital to LP investors?
Yeah, that's another great question. It'll depend on what the circumstances are. If we're able to, I would say this: when interest rates are where they were 2.5% to 3%, and if you held the property 4 or 5 years, we were able to refinance, pull cash out, and we did offer to buy out investors at a very nice return. And it was an offer, so they could reject it. Some took it, some rejected it and stayed in the property. But the current interest rate environment is unlikely that you could go and refinance, unless you're 15, 20 years down the road, you've amortized that debt down enough. In the first 5 or 10 years, you're not amortizing enough to really to be able to go and refinance, at least not in the current banking environment, right? Because they're more restrictive right now. They're having trouble with their syndications, loans. So, if we do refinance and we're able to pull out cash, we may distribute that to everyone, or we may offer to buy out people at a higher return. And it's really up to each individual investor to make the decision what they'd like to do, It's your choice. You're not forced into anything.
Okay. Well, thank you very much. And thank you to the audience for all of these great questions. Before we close out, I do want to point out to the audience, everyone has my email address. If you want to dive in deeper, please reach out to me. I can connect you. And I know, Terrence had put up the slide at the end. You can contact them directly as well. In turn, they will have all of your information and will be reaching out. So be on the lookout for that. And Terrence, I want to turn it back over to you for final words before we close out.
Well, again, thank you for setting this up, and to Forrest family for doing this. We have a larger pipeline this year because we did hold off, when interest rates were increasing and during the COVID, we held off on developing. We did a smaller number. And so we have a larger pipeline. We have more opportunities. And we're very interested in taking on some additional investment capital from family offices, and would love to partner with people to do that and provide them with a nice, solid real estate return, on an asset that, you get extra benefits compared to stocks or bonds. And it's real, it's tangible, and you're doing something great for the, society in terms of community and revitalizing these communities. So it just has a lot of benefits. I really enjoy seeing people use our properties, in addition to how great they look, and you're an owner, so you can kick the tires, you can show your friends that you're an owner. And it's just a terrific thing. And historically, real estate, through the centuries has been the primary wealth builder. If you look back over hundreds of years. So it's a great thing to have in your portfolio, and everybody should have some real estate. And Helen here can help you evaluate what's the best, property to invest in, looking at depending on your goals and your aspirations. And we also help people, by the way, with their estate planning. We're not estate planning people, but we help them, set up, if you want to set up a family LLC, or we're working with your attorney, where you can invest on, so that your children or your grandchildren can benefit or pay for college, whatever. That's another terrific way to invest, depending on what your goals are. So again, thank you very much. Really appreciate it.
Thank you. Thank you so much. And thank you everyone for joining. Have a great day.